Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, the week certainly started quite well on Wall Street. The first few days, the market really shrugging off rather poor economic news and continuing to climb, and then gave it all back, plus some, on Friday to end the week lower. The economic news on all fronts really wasn't good for the whole week, but it was the very weak manufacturing figure combined with oil going through the $103 a barrel barrier that really sent the market into a tailspin on Friday. Investors really just are very concerned about the health of the American economy going forward now, and despite reassurances at government level, the actual figures coming through, especially with corporate profits showing very, very weak figures now, really just give the whole market the feeling that there's really no good news on the horizon. The real worry, of course, is that even though we feel we've had an extended down period over the last 8 months, we really haven't had that much of a drop compared to the overall level of the market. And if you look historically back at different levels, support levels, etc., we could still have another 300 to 400 point drop in the Nasdaq still possible. Taking a look at the Nasdaq chart, you'll see that we really probably have only just completed the first leg of the downtrend. We're going to take a look at the 1-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas, we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so, on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, and one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks, before then the market would probably turn southwards again. Well, the technical picture shows that we still really haven't broken out of the triangle pattern that has formed over the last few weeks, but it looks likely that we're going to, and it looks likely that that will be to the downside. The Friday sell-off really did show that it was unlikely to break out of the top side of the triangle. But we're still technically within the consolidation triangular pattern, and who knows, next week we could get another attempted rally and stay within that triangular pattern for another week or two. But we'll be watching carefully, because I do feel that there was momentum on the downside on Friday, and it may very well have enough to carry it through and penetrate the lower border of the triangle pattern and break out to the downside. But of course, investors are expecting another rate cut at the next Federal Reserve meeting, and I think they've already priced in a half percentage point cut. If this does in fact transpire, this may well stop the market in its tracks again and cause a little rally. But our overall feeling still is that the market is going to gradually decline, and not much is going to save it. You'll have these periods of intermittent news or a Fed rate cut, which will certainly help in the short term. But generally speaking, we feel that there's a lot more time to play this bear market phase out, and it's unlikely that we're going to see any a real improvement in the market condition until midsummer or late summer at best. The US dollar hit a new low against the euro again this week, and that should really be good for stocks in a sense, because it makes US dollar denominated assets such as stocks attractive to the foreign buyers. But even that isn't helping the situation. We'll be keeping a close watch on it again this week for you, and until next week, it's goodbye from London.